Hello everyone, I hope you are having a good day. So we are continuing IFRS 2. This is one of the most technical topics of IFRS 2 where I combine IAS 12's knowledge, income taxes, deferred taxes knowledge with IFRS 2. This is one area where I have multiple times seen that students often get confused and students are very much not clear about how deferred taxation impact should be accounted for in an examination scenario. This has also been tested in an examination. I believe it's tested twice up to date, including P2 and SBR. So I suggest that you carefully look onto this lecture and let me have your feedback. So I'm talking about deferred taxation on share-based payment. So just to give you a very brief recap, how did we use to calculate deferred tax? So basically, deferred taxation arises due to accounting differences between, accounting principles and tax principles. So what we used to do was we used to compare carrying values with our tax base, and as a result, we used to get temporary differences. All right. And these temporary differences either used to be taxable temporary differences or deductible temporary differences. The taxation effect of these differences, if you had a taxable temporary difference, you had a P&L charge. If you had a deductible temporary difference, you had a P&L credit. Now this is a brief background of what deferred tax actually required. Now, what happens in the case of a share-based payment? Please try to understand the point I'm trying to make. This is a very specialized case which is discussed under IFRS 2. So IFRS actually gives you specific guidance about how to account for the taxation impact of share-based payment transactions. Often, there is a difference between what expense we recognize on account of share-based payments and what deductible allowance is allowed by the taxation authorities. Just follow me what I'm saying. All right. It is often seen that the amount of share-based payment expense that we recognize in our financial statement differs from the deductible allowance that taxation authorities allow. For example, in the case of equity settled share-based payments, we use fair value at grant date to recognize expenses. But the taxation authorities may allow a deductible allowance in such a transaction based on the current intrinsic value, of those options. You remember, in equity settled share-based payments, we did not use to perform mark-to-market valuations. That means we always used to follow fair value at grant dates. Those were the initial fair values of the options. But the taxation authorities may allow a different expense which is based on a different value. Hence, temporary differences would arise. Sir, which type of temporary difference would arise? IFRS 2 has given very good guidance. The difference between the amount of taxation authorities will permit as a deduction in future periods for services received to date and the carrying amount of 0 is a deductible temporary difference. IFRS 2 says it is always going to be the case of a deferred tax asset. Always. Why? The accounting entry that we prepare in our books is expense debit equity option credit. No asset, no liability. So if we follow the traditional IAS 12 route, for the share-based payment, our carrying value of asset or liability is going to be 0 because there is no asset, no liability, equity the share-based payment asset liability is zero, carrying value is zero. But the tax base, the amount of benefit that is recoverable from the tax authorities will always be positive, always be positive. For example, we will receive a tax benefit of 100. This will mean there is a temporary difference of 100, and hence, since carrying value is less than your tax base, this will be a case of deductible temporary difference. If you multiply it by tax rate, you will get a $20 deferred tax asset. Make sense? Now, since in the case of equity settled share-based payments, our carrying value is zero. For example, expense debit, equity credit. There is no asset or liability. So the amount of carrying value of asset or liability would be zero because no asset or liability has been recognized in this accounting entry. But the tax benefit being allowed by the taxation authorities, the amount of tax benefit that we have to receive from taxation authorities will ultimately be a certain number until and unless it is a permanent difference. So ultimately, since this carrying value is zero, there will always be a case of deferred tax asset. There will always be a case of deferred tax asset. Carrying value 0 versus tax base is equals to deferred tax asset. Always be the case. Now there are 2 points here to be understood. Number 1, in the case of deferred taxation on share-based payments, since the carrying value will always be 0, there will always be a deductible temporary difference, hence a deferred tax asset. Point 1. Point number 2, there will also be a difference between what we treat an expense according to fair value at grant date and what taxation authorities allow as a deductible allowance. In most cases, taxation authorities would be allowing a deduction based on the share price at the end of the period, or based on an estimated price based on the information that is available at the end of the period. So very commonly, taxation authorities ask us that you estimate that what is going to be the share price at the vest date, what is going to be the share price at the vest date, and we will allow you a deductible expense based on that expected share price. Now our IFRS 2 says use fair value at grant date, but routinely almost all taxation authorities allow a deductible expense based on the expected share price, and that too at the vest date. So definitely there is a temporary difference between what they are saying and we are saying. All right. So this is how a difference will arise. All right. Now there is one very important point, and which is going to be of much use when we see the upcoming example, and this is very important for your exam, very important, just learn it. IFRS 2 says that if the amount of tax benefit exceeds, if the amount of tax benefit, not the difference, the amount of tax benefit exceeds the cumulative share-based payment expense, then the excess is recognized as a deduction in equity. Now this is very technical point, I might tell you. They are saying if the amount of tax benefit exceeds the amount of cumulative expense being recognized in accounting, for example, cumulatively, year 2, year 3, cumulatively, whatever the case may be, you have recognized a share-based payment expense of 100. Now in accounting, if you are recognizing an expense of 100, the tax benefit of that expense should never be more than 100. It should not be more than 100. How can a tax benefit can be more than the whole expense? The accounting standard is saying that if you get to know that the amount of tax benefit actually exceeds the amount of accounting expense that has been recognized in the books, then wait, the excess would be treated as a deduction in equity. The benefit would go to equity, not P&L. You see, for matching purposes, we cannot allow excess tax benefit. We cannot allow excess tax benefit, which is more than the expense itself. For $100 expense in accounting, we cannot allow you a tax benefit of $120. But the question that comes into your mind when I say this is, sir, how is the tax benefit more than the expense itself? Because taxation authorities may be allowing tax benefit based on the expected share price, which may be much more higher than the fair value of grant date. Hence, the amount of tax benefit that tax authorities may be allowing may be more than the accounting expense that we are booking. Do you understand what I am trying to say? If there is a case that the tax benefit actually exceeds the amount of expense, sir, how will the tax benefit be more than the amount of expense itself? Because the taxation authorities take fair value not of the grant date but of the prevailing vest date, of the expected price of the reporting date. Hence, the share price may be expected to appreciate a lot, maybe 200, 300, 400 times. And when you multiply that 400x price with the tax benefit may ultimately be more than the cumulative expense that we are recognizing in accounting. For matching purposes, we cannot allow you the excess 20 benefit to be recognized in P&L. We would treat this as a deduction in equity. Sir, we can only understand this very difficult concept if you give us an example. I am going to give you an example, but you need to focus here. This is a technical topic. So your examiner says, for example, ABC Corporation grants options for 20,000 shares on 1st January year 1. So 1st January year 1 is basically your grant date, my friends. And at year 1, 1st January year 1, we have given 20,000 shares as an option. When the grant date fair value of the option is $15 per share. When the grant date fair value of the option is $15 per share. This is fair value at grant date. Now, my friends, since we are talking about options, we are talking about equity settled share based payments. My friends, fair value at grant date is only relevant for us in accounting. As you have studied in IFRS 2. The examiner says the options vest on December 31st year 1. So the vesting period is only 1 year when the intrinsic value is $18 per share. Now the intrinsic value is more than the fair value at grant date, and that can happen. Obviously, that's not a big deal. All right. So the prices do increase after the grant date. So at grant date the fair value was $15, but by the end of the year, although it's not relevant to us in accounting as per IFRS 2, but the intrinsic value is $18. The share price has appreciated. Good for the employees. It says ABC recognizes 300,000 as compensation expense in year 1. Now, is this correct? Yes. In year 1, there were 20,000 shares granted, SOPs granted share options. Each had a fair value at grant date of 15 and vesting period of only 1 year. So 20,000 into 15 is 300,000. Accordingly, the company has recognized an accounting entry, expense debit 300,000, equity option credit 300,000. It's a very good accounting entry. But sir, the question is, what about deferred taxation? What about deferred taxation on this 300,000 impact. It says all share options are exercised next year on year 2 when the intrinsic value was $20 per share. By the way, the equity options were exercised next year. So that's fine. Next year, we'll take care of it next year. Now, this is an important point your examiner is trying to make. Your examiner says, in its tax jurisdiction, ABC receives a tax deduction related to share-based payments when the options are exercised. The deductible amount is the option's intrinsic value at the date of exercise. Tax rate is 25%. So for example, at the end of year 1, please look into it. So for example, at the end of year 1, when the accountant is trying to analyze what is going to be the deferred taxation impact, according to IS 12, it is going to make 3 columns: carrying value, tax base, and the temporary difference. So in the case of share-based payments, since an equity is recognized, no asset, no liability is recognized, the carrying value is 0. Sir, but what about the tax base? It was written that in tax jurisdiction, ABC company receives a tax deduction related to share-based payment when the option is exercised, and the deductible amount is the option's intrinsic value. The deduction is allowed based on intrinsic value, my friends. So when I'm standing at year 1, please look into it. When I'm standing at year 1, I see that I have 20,000 SOPs and I try to estimate the intrinsic value of these SOPs. It would be $18. Now some of you might argue, sir, wait. It's clearly mentioned in the question that on year 2, when the people actually exercise their options, the intrinsic value actually was $20. Sir, why are you taking $18's value when you are doing this calculation? Oh my students, just use your brains. $20 price was in year 2. How would we know that in year 1? Your examiner is trying to confuse you. That $20 price is the actual intrinsic value at the exercise date. But when we are doing accounting for year 1, we are standing at year 1. If we are standing at year 1, we don't know what's going to happen in year 2. Obviously, this is an examination question. That is why we know that ultimately what happened. But when an accountant is doing accounting on year 1, how would it know that on year 2 it is actually going to close at year 20 at $20? This part your examiner has just tried to confuse you. It's useless. Nobody knows what is going to happen in year 2 when you're standing at year 1. So you can only take an estimate based on the information that is available on year 1. That is what the standard requires. You're not God that you know what is going to happen in year 2. So I try to estimate what should be the value, real value, intrinsic value as per the tax jurisdiction, and $20,000 into 18 is going to be the deductible allowance from my side. So 20,000 into 18 is 360,000. So the tax base, the amount of tax benefit that I will have is basically 360,000. So 0 against 360,000 is a temporary difference of 360,000. And if you take the taxation impact of it, just multiply it by tax rate, 25%. 360,000 into 25%, my friends, is 90,000. Okay. So 90,000, this was basically DTD, deductible temporary difference. And therefore, this is a deferred tax asset. So my friends, all in all, I have to recognize a deferred tax asset on this transaction of 90,000. This is what has been already been done. So normally what the accounting entry is that deferred tax asset debit and you credit the P&L. But wait, my friends, wait. Didn't you just see that the amount of tax benefit exceeds the amount of cumulative expense? In the share-based payment account, we have recognized an expense of 300,000. However, the tax benefit, the deductible allowance that we are being offered is 360,000, 60,000 more than our expense. So this additional impact, this 60,000 additional impact, I am writing it here, 60,000 additional impact has to be accounted for. The taxation impact of this additional benefit has to be accounted for in equity. So the additional 60,000 taxation impact, 60,000 into 25 is 15,000. This will be credited in equity. And the rest of it goes into P&L, and that should be 75,000. Obviously, we cannot allow you a deductible allowance which is more than the expense itself. The tax benefit should not increase from the purview of matching concept. It should not increase the cumulative expense. The additional goes into equity. My friends, this is a very difficult concept for many, but for you, if you look at this again and again, I don't think this is going to be very much difficult. This is one of the areas that your examiner has been testing quite a few times, and this is a must have of IFRS 2 if you're going into the SBR exam. Regardless of the SBR exam, whatever qualification that you're studying, I believe this is one of the key areas that you must possess. Again, if you have any further queries, I am always available. Just feel free to contact me on the given particulars, and I'll try to help as much as I can. See you. Have a good day. Bye-bye.